course, this week's market rally has proven to be short-lived. Markets have put the brakes on those gains. And for more on the meltdown, which does come ahead of a very important decision for South Africa's ratings, I am joined on Skype and also on Zoom by Dale Hutcheson, who is a fund manager at Absa Asset Management. Chris Holdsworth, Chief Investment Strategist for Investec Wealth and Investec South Africa, and also Cobus Cilliers, Head of Investments from Mosaic Financial Solutions. Gentlemen, thanks so much for your time. I'm just interested in your views on, what did really trigger this plunge down. We have seen a lot of buying activity coming to the markets this week. I mean, were those just short-term traders, or were they long-term investors that were positioning themselves for what looked to be an upturn and the end of COVID-19 from a markets perspective up until today? And Dale, just to begin with you.
Obviously, I think we've had a couple of very good days, but it's, there's going to be volatility in this market, and things don't go up in a straight line and they don't fall in a straight line either. I think we've seen markets respond positively to stimulus, particularly out of the US, and that's certainly driven a appetite for risk, and hence the rand strengthened, and we saw generally markets performing quite well. But I think that stimulus now is in the base, and obviously the news flow is all around the impact the virus is actually having on the underlying economies, and that's all negative news. So you're going to see volatility. I think the stimulus will have positive impacts down the road, but they're certainly not going to be, it's in the headlines. It's not in the headlines today.
Chris, how do you explain what is going on markets right now and where we're likely to go? Because, I mean, for the most of this week, the markets were sapping up the fact that $2 trillion was going to come in from the US. Just yesterday, the G20 are talking about injecting further stimulus to the tune of like $5 trillion, I do understand. Yet markets are not reacting positively to that news. So your explanation or understanding of what did drive things lower today?
Yeah, I think that's right. We need to view this through two important factors that are driving markets at the moment. On the one hand, you've got commitments from governments from a fiscal perspective and from central banks from a monetary perspective to do what it will take to ensure that growth continues. And whatever pain we endure will be short-term in nature, and we won't land up with structural damage to the economy. That's on the one side. On the other side, we've got this virus which continues to grow. And the numbers continue to grow at around about 15% per globally outside of China. And the longer that continues, more likely it will be that there will be structural damage to the economy, and we'll be looking at a U-shape type of growth for the economy rather than a V-shape. And so I think the debate in the market is whether it's V or U. And what we saw over 3 days was this massive commitment from a fiscal and monetary policy perspective to make sure that it's a V. We'll do everything. And then we just started to see that the numbers from a growth perspective of the virus just aren't slowing. And we saw the US overtake China. We saw the numbers in the US still growing at over 20% per day. We saw the numbers in Spain still growing at 15% per day. And I think the concern with the market will only be fully alleviated once we can start to get an idea when the peak number of daily infections is likely to be. And we don't yet have that in sight. But bear in mind, we had 3 days, which cumulatively saw a 20% rally in the US market. Today, we've seen back about 4% or so. So we're still up for the week. So thus far this week, it's still the stimulus effect that's winning. But there are still these large residual concerns about the extent of the virus.
Right. U-shape, a V-shape. I've heard the view that it could possibly be an L-shape recovery. I mean, so many different views. And Cobus, just to bring you in here on your understanding of what is going on in these markets and how you are playing them, how you have positioned yourself for the expectation of either kind of shape of recovery.
Surely. Thanks for having me on the call, Phoebe. So our family office clients, we are extremely conservative. We've taken a tactical allocation view that things are going to get worse. So we've basically shifted or repositioned all our asset allocations towards a lower risk asset class. So even if it's an investment grade fixed income security, we've sold that out because we've just gotten liquidity from the Fed this week, and we moved that into either US Treasuries or US gilts, depending on what the client's mandate is from a currency perspective. But we're quite negative about what's going to happen in the economy. in South Africa as well as internationally. And given that outlook for the next 3 to 6 months, we do believe a lot of negative news are going to come to the markets. And in that environment, you want as much liquidity as you can, and in the lowest asset class that you can be in.
All right, so let's talk about the story that we all want to know about, right? So to downgrade or not to downgrade, because I mean, that will be the ultimate question later on this evening. Many say that because of what we have seen in terms of the losses in the markets in South Africa, particularly what you're seeing today, that whether or not Moody's downgrades us to junk status, it's not really going to have much of an impact. What is your view, gentlemen? And Dale, again, to begin with you.
I mean, I tend to agree that maybe the impact is going to be muted. Well, to start with, the FTSE certainly indicated that it's not doing a rebalancing exercise of the World Bond Government Index. And that certainly means you've got some delay in terms of being taken out of it should we be downgraded slightly. But I do think that given the volatility that we've seen in the market and given how bonds have blown out to some extent, although clearly the SARB's got involved and trying to create some liquidity there, I do think it's not going to be seen as the beginning and end all of everything. I think the rand has already weakened in the backdrop of this very difficult macroeconomic environment. So I think it's a bit in the price. I think there's got to be a strong probability that it happens, purely because our fiscal position has certainly deteriorated thanks to the COVID-19 virus. But yes, I do think there's a strong probability that it happens.
I mean, to bring you back in here, Chris, an interesting view, because Investec has the view that a downgrade isn't going to happen. I was just reading a note by your chief economist a little earlier. She says that a downgrade might not happen later on this evening because, I mean, this economic shock from COVID-19 is not limited to South Africa alone. Everybody is being impacted by this, and this could be one of the reasons why we escape yet another chopping to junk status. But if you are holding that view, what then are you doing with your money in the market, Chris?
Yeah, I think one needs to look at this in two ways. One, there's the view held by Investec in aggregate, which with regards to a downgrade later today, and it may be the case that Moody's gives us grace again because of extenuating circumstances. That's a possibility. But we must also consider what the market's view is. And as you mentioned earlier, the consensus view is for downgrade, and then the question becomes, what happens if we're wrong? What happens if the downgrade actually does occur? Is it priced in? And our belief is that it is. So even if it doesn't occur, if it does occur, we think that yields in South Africa currently are attractive enough to compensate for that risk. And to affirm that view, what we've done is we've gone back over time and looked at other countries that have been downgraded into junk status. And for all of them, what typically occurs is immediately subsequent to a downgrade, you do see yields blowing out, but 3 months later, for every single incident, you see yields compress relative to global peers. And now for South Africa, for over 2 years, we've been talking about the possibility of a downgrade in South Africa. I mean, if you look at our yields, our dollar-denominated yields, they're higher than Brazil. Brazil is rated worse than South Africa. So we're being priced not just to be downgraded to be equivalent to Brazil, but to be downgraded beyond that. In addition, in the backdrop, we've got the SARB that's announced QE. So the concern about a downgrade has been for some time. You'll get this forced selling from constituents or people or index trackers that follow the weekly, and they will have to dump South African bonds into a market where not many people are buying. Well, now we've got the SARB that's come out and announced they will be buying bonds. So even if we were to compare it to other countries where the effects suggest it's likely to be short-term, we now are different because we've actually got a buyer in the market as well, which is going to provide liquidity in that environment. So we think there may well be a blowout if it is the case with the downgrade, but we think it will be short-term in nature, and we still like bonds at their current yields. We do think they're very attractive.
All right. Cobus, I know you say that your investment house is taking a very a prudent and a conservative view right now in terms of your asset allocation. But those who are interested in dabbling in a bit of risk and who have seen the stock valuations come down and are saying, listen, I've got a bit of extra cash on the side and I want in. What would you tell them to buy right now?
if you do have the risk appetite and you can stomach the volatility, I think what you want to look at companies that's got very strong balance sheets, companies that's got a very good moat or very good brand name out there, and that's going to do well in 6, 12, or 18 months from now. There's a variety of companies that are not going to make it through this economy, unfortunately. So those are the companies you want to avoid, and those will be the companies that do not have liquidity. So, liquidity crisis. Unfortunately, you don't want to have a liquidity crisis become a solvency crisis, and that's why you want to make sure that you invest in the companies that's got the strongest balance sheets and will have demand for their products within the next 6 months to 12 months.
Yeah, because everyone keeps on saying that. So in your view, which are those companies? Which are the companies with the strongest balance sheets that you would be advising those who want, to play with a bit of risk, to put their money in? And which are the companies, in your view, do you think may not make it through this?
So it's a little bit difficult to mention names because it's a personal view, or it's a house view. But a company, for example, that will be very strong once we're through this will be a company like Richmond. So Richmond has got cash on the balance sheet. It's got a very strong brand name. But given the current travel restrictions, the demand for the product will be very low because most of the demand comes from people traveling, and those are your luxury consumers. But given this, and as you said, someone that's got a lot of risk appetite, a company like that over the long term will tend to benefit from this.
All right, and gentlemen, Dale, as for you, what would you be buying right now if you did have a bit of risk to play with?
I mean, I can echo Cobus's comments about quality of balance sheets. You don't want to pick companies that have a lot of gearing, etc. I certainly think some offshore exposure, or these companies with more diverse offshore portfolios, such as Moody, for example, I think looks very good. Again, it's a company that, in 12 months' time, the trend towards paper packaging continues. So I think that would certainly tick a box that a company is going to survive. It's got a strong balance sheet. And I'd also be hesitant to mention which companies will fall over, because it is very difficult to call at this point in time. But for now, I certainly think you've got to favour food retail over apparel retail, just because they're at least doing some business where apparel retail is obviously not being able to operate in a South African context. Those are some of the ideas that I'd have.
And Chris, your view?
Yeah, I think what we've seen over the past couple of weeks, and perhaps even months, is indiscriminate selling across the market because of this deep desire to have cash, whether it be South African cash in the local market or dollar cash overseas. And as a result of that, we've seen a lot of companies that are very high quality, that have bulletproof balance sheets, in our view, get absolutely hammered. And so the opportunity that's presented now is to be able to improve the quality of one's portfolio and pick up some higher quality counters at discount prices. Now, that implicitly assumes that one's got some cash to deploy, and may well be the case. It's time to switch as well from some companies whose futures have become more uncertain at this point into higher quality counters. That's within equities. From an asset class perspective, South African bonds, we debated earlier, we view are pricing in the downgrade completely. And inflation linkers in South Africa are offering yields, depending on the day you look at it, between 5 and 6%. Recently, it got just a bit below 5. But those are incredibly attractive. Those are the sort of yields you would normally demand from the equity market. You're getting it from bonds. So I think there are opportunities across asset classes and within equities, but particularly higher quality counters. And unfortunately, that's not much different from the two previous speakers, so I'd be agreeing with them.
All right, so gentlemen, we'll leave it there. Thanks so much for your time. Of course, in conversation with Dale Hutcheson, the fund manager at Absa Asset Management, Chris Holdsworth, chief investment strategist at Investec Wealth and Investments, and also Cobus Cilliers, head of investments from Mosaic Financial Solutions.